The silver market just flashed a warning signal that hasn't appeared since the global financial crisis. And if history is any guide, what happens next could reshape portfolios, disrupt industries, and create opportunities that only come around once in a generation. But here's what makes this moment different. This isn't about speculation or hype. This is about fundamental market breakdown. Physical supply chains are fracturing. Paper markets are disconnecting from reality. And the largest exporter of silver just slammed the door shut on the global supply chain. If you're watching this video right now, you're among the first to understand what's actually happening beneath the surface, while the mainstream financial media is still scratching their heads trying to explain the volatility. Let's talk about the crisis signal that everyone's missing. Silver just experienced something extraordinary. In the span of 7 trading days during January, the metal surged from around $80 per ounce to an intraday peak of $117.75. Then came the crash. Within 30 minutes on January 30th, silver plunged 17% from its weekly highs. Gold fell 7% to $4,940. The volatility was so extreme that trading systems struggled to keep up. Retail investors watched in disbelief as their positions swung wildly, and institutional traders scrambled to manage risk exposure that suddenly became unmanageable. But here's what you need to understand. This wasn't random chaos. This was the visible symptom of something breaking in the underlying structure of the silver market. And let me explain the technical signal that's flashing red right now. When you see violent price swings of this magnitude compressed into such short time frames, it tells you something critical about market liquidity. Liquidity is the oil that keeps price discovery functioning smoothly. When a market has deep liquidity, large orders can be absorbed without moving prices dramatically. But when liquidity dries up, even modest selling pressure can trigger cascading moves. What we witnessed in late January was a liquidity crisis, and the exchange operator's response confirms it. The Chicago Mercantile Exchange, which operates the COMEX silver futures market, raised margin requirements not once but multiple times in the span of 2 weeks. For non-heightened risk profiles, silver margins climbed from 9% to 11%, then to 15%. For heightened risk profiles, margins jumped from 12.1% to 16.5%. That's a 36% increase in capital requirements for leveraged traders. Now, if you're not familiar with margin requirements, let me break this down. When you trade futures contracts, you don't need to put up the full value of the contract. You post a margin, essentially a good faith deposit. But when the exchange raises margins, it forces traders to either inject more capital or reduce positions. And here's where it gets interesting. Many traders don't have spare capital sitting on the sidelines, so they're forced to liquidate. Margin hikes during extreme volatility create a vicious cycle. Prices fall, triggering margin calls. Traders sell to meet margin requirements, pushing prices lower, triggering more margin calls. It's a cascade, and it's exactly what we saw. The last time we witnessed this pattern was during the financial crisis, when exchanges hiked margins on precious metals as investors rushed to liquidate positions to cover losses elsewhere in their portfolios. The parallel is striking. But the margin hikes are just one piece of the puzzle. Let's talk about what's happening in the physical market, because this is where the real story unfolds. During the first week of January, COMEX warehouses experienced withdrawals of 33.45 million ounces in just 7 days. That's 26% of available inventory disappearing in a single week. On Wednesday, January 7th alone, 3.25 million ounces were withdrawn with 0 ounces deposited. Think about what that means. Someone, or more likely multiple large entities, are pulling physical silver out of the exchange system at an unprecedented rate. They're not selling, they're not trading, they're taking delivery and removing metal from the pool available for price discovery. This creates a dangerous dynamic. Futures markets rely on the assumption that physical delivery is possible if needed. It's the mechanism that keeps paper prices tethered to physical reality. But when available inventory drains rapidly, that tether weakens. And we're starting to see evidence of decoupling. Reports from dealers and refiners indicate that physical silver is trading at significant premiums to paper spot prices. In some international markets, physical premiums have reportedly reached 30 to 50% above COMEX futures prices. That's not normal. That's a market in structural stress. When physical and paper prices diverge, it signals that the paper market is no longer accurately reflecting supply and demand realities in the physical market, and once that divergence begins, it tends to accelerate. Now let's add the supply-side catalyst that nobody's fully pricing in yet. On January 1st, China implemented new export licensing requirements for silver. Previously, any qualified company could export silver from China. Now, only 44 specifically approved firms are authorized to ship silver abroad. China is the world's largest silver producer, accounting for roughly 13% of global mine supply. More importantly, China processes vast quantities of silver for industrial use and has been a significant exporter of refined silver products. By restricting exports to a small group of state-approved entities, Beijing has effectively weaponized silver supply. And they've done it at precisely the moment when industrial demand is surging. Why does industrial demand matter so much? Because silver isn't just a precious metal. It's a critical industrial commodity with unique properties. Silver has the highest electrical conductivity of any element. It has the highest thermal conductivity. It's the most reflective metal. These properties make it irreplaceable in electronics, solar panels, electric vehicles, and emerging technologies like artificial intelligence data centers. And here's the kicker. Industrial demand for silver has been growing at over 5% annually, with some sectors like solar manufacturing seeing growth rates above 20% year over year. The Silver Institute's data shows that industrial fabrication demand consumed approximately 570 million ounces in the most recent year, representing roughly half of total annual demand. Meanwhile, global mine production is essentially flat, constrained by declining ore grades, rising production costs, and environmental regulations. This brings us to the supply deficit that's been building for 5 consecutive years. In each year from 2021 through 2025, silver demand exceeded mine supply by significant margins. The projected deficit for 2025 alone was approximately 95 million ounces. But here's what makes that number truly significant. Those annual deficits are cumulative. Industry analysts estimate that between 2021 and 2025, the cumulative supply deficit totals approximately 820 million ounces. That's nearly an entire year's worth of global mine production. When you run persistent deficits, the shortfall has to be made up from somewhere. It comes from above-ground inventories, from exchange warehouses, from dealer stockpiles, from recycled scrap, and eventually from elevated prices that ration demand and incentivize new supply. But here's where it gets really interesting. Despite 5 years of deficits, silver prices remained relatively subdued until recently. How is that possible? The answer lies in the structure of the futures market. The vast majority of silver trading happens in the paper market through futures contracts, options, and exchange-traded funds. Only a tiny fraction of contracts result in physical delivery. Most traders close their positions before expiration or roll them forward. This creates a market where price discovery is dominated by financial speculation and hedging activity rather than physical supply and demand. It's a system that works beautifully when everyone trusts that physical delivery is available if needed. But it's a system that can break spectacularly when that trust evaporates. And trust is evaporating right now. When COMEX inventories drain by 26% in a week, it sends a message. When China restricts exports through licensing, it sends a message. When physical premiums surge to 30 or 50% above paper prices, it sends a message. The message is simple. The paper market no longer accurately represents physical reality. And once that perception takes hold, the feedback loop accelerates. Investors who previously held paper silver through ETFs or futures contracts start questioning counterparty risk. What happens if there's not enough physical silver to back the paper claims? What happens if a shortage forces cash settlement instead of physical delivery? These aren't hypothetical concerns anymore. They're live risks that sophisticated investors are actively hedging. Now, some of you might be thinking, this sounds like a short squeeze. And you're partially right. There are elements of a short squeeze dynamic at play. Silver has long been one of the most shorted commodities in the futures market. Commercial hedgers, primarily mining companies and industrial users, hold substantial short positions as part of their normal hedging operations. But there are also speculative shorts, traders betting that prices will decline. When prices rally sharply, shorts face losses and potential margin calls, forcing them to buy contracts to close their positions. That buying pressure pushes prices higher, squeezing more shorts, creating a reflexive feedback loop. But calling this purely a short squeeze misses the bigger picture. This is a structural supply shortage masked for years by abundant paper supply suddenly becoming visible as physical tightness overwhelms the paper market's ability to obscure reality. Let me give you a framework for thinking about what happens next. There are essentially 3 possible scenarios. In scenario 1, volatility subsides, physical premiums normalize, and the market stabilizes at a new higher price equilibrium. This is the soft landing scenario. It assumes that higher prices ration demand, incentivize increased recycling, and potentially bring forward new mine supply. It also assumes that the paper market maintains credibility and continues to function as the primary price discovery mechanism. In scenario 2, physical and paper markets remain disconnected, with physical premiums staying elevated while paper prices remain volatile. This is the dual market scenario, where investors increasingly differentiate between paper exposure and physical ownership. It's similar to what we've seen periodically in gold markets during crisis periods. In scenario 3, the paper market experiences a credibility crisis, leading to a rush for physical delivery that overwhelms available supply. This is the breakdown scenario, potentially resulting in force majeure declarations, cash settlements, and a complete repricing of physical silver significantly higher. Which scenario is most likely? Honestly, nobody knows for certain. But we can look at precedents. During the 1970s, silver experienced a massive bull market, culminating in the Hunt brothers' attempt to corner the market. Prices reached $50 per ounce in 1980 before crashing. But that was driven by speculative mania and leverage, not fundamental supply deficits. A better comparison might be the palladium market in the late 1990s and early 2000s. Palladium experienced persistent deficits driven by automotive catalyst demand. Russian state stockpile sales provided supply, masking the deficit. When Russian sales stopped, palladium prices exploded from under $200 per ounce to over $1,000. The parallel to silver is instructive. You can run supply deficits for extended periods if there's a buffer, but when the buffer disappears, prices adjust violently. So, what's the contrarian insight here that most investors are missing? The mainstream narrative treats this as a volatility event, a speculative blow-off top followed by a healthy correction. That narrative assumes normal market dynamics. But the evidence suggests we're not dealing with normal market dynamics. We're dealing with a structural transition from a paper-dominated market to a market where physical scarcity reasserts pricing power. And that transition is inherently volatile because it requires a complete repricing of risk. The paper market priced silver as if physical supply was essentially infinite at the margin, available whenever needed. The physical market is now demonstrating that assumption was false. The repricing of that assumption is what creates opportunity. Now let's talk about the industrial implications, because this is where the second-order effects become really interesting. Elon Musk publicly warned in late December that China's export restrictions on silver were not good, because silver is needed in many industrial processes. He's right. Tesla uses silver in vehicle electronics. SpaceX uses silver in spacecraft systems. Most electronics manufacturers rely on silver for conductors and contacts. Solar panel manufacturers use silver paste for photovoltaic cells. The explosive growth in artificial intelligence is driving demand for data centers, which consume massive amounts of silver in servers and cooling systems. These industries have based their cost structures and growth projections on the assumption that silver would remain available at reasonable prices. That assumption is now being challenged. What happens when a critical input becomes scarce and expensive? Several things. First, companies scramble to secure supply through long-term contracts and vertical integration. We're already seeing reports of industrial users approaching miners and refiners to lock in supply commitments. Second, companies accelerate research into substitution and efficiency improvements. Can you use less silver per unit? Can you substitute copper or other metals for certain applications? These efforts take time and often sacrifice performance. Third, companies raise prices to pass through input cost increases. Solar panels become more expensive. Electronics become more expensive. Electric vehicles become more expensive. This creates inflationary pressure in key growth sectors of the economy. And fourth, some marginal projects and business lines become uneconomical and get canceled or delayed. If you can't secure silver supply at a price that makes your product viable, you don't produce the product. This is why the silver story isn't just about metal prices. It's about potential constraints on the energy transition, on AI infrastructure build-out, on consumer electronics production. It's about whether we have sufficient supply of a critical material to support the technological transformation that everyone assumes is inevitable. And if we don't, if silver becomes a bottleneck, then either we find solutions through higher recycling rates, new mining projects, substitution, and efficiency improvements, or we accept that certain growth trajectories will be slower and more expensive than projected. Either way, silver becomes dramatically more valuable, both as a commodity and as a strategic resource. So, what's the actionable framework here? If you're an investor, the question isn't whether silver goes up or down next week or next month. The question is whether you believe the structural supply deficit is real and whether you believe industrial demand growth continues. If the answer to both is yes, then silver exposure makes sense despite volatility. But there's a crucial distinction between paper exposure and physical ownership. Paper silver through ETFs and futures offers liquidity and convenience, but it carries counterparty risk and potential cash settlement risk if physical shortages intensify. Physical silver through coins, bars, or allocated storage offers true ownership and no counterparty risk, but it carries storage costs, liquidity constraints, and typically higher transaction costs. The right choice depends on your goals, your risk tolerance, and your time horizon. If you're an industrial user, the framework is about supply chain resilience. Can you secure long-term supply commitments at fixed or capped prices? Can you forward buy inventory to buffer against potential shortages? Can you accelerate substitution research to reduce silver intensity in your products? These aren't pleasant conversations, but they're necessary conversations if silver remains tight. And if you're a mining company or someone with exposure to mining equities, the calculus is about whether higher prices translate to profitability or whether costs rise just as fast as revenues. The best positioned miners are those with low-cost production, long mine lives, and the ability to bring new supply online without excessive capital spending or permitting delays. Here's what most analysis gets wrong about this situation. There's a tendency to think in terms of price targets. Silver will go to $100 or $150 or $200, but price targets miss the point. The point is that we're in a regime change. For the past several decades, silver traded primarily as a financial asset with industrial characteristics. Going forward, silver may trade primarily as an industrial commodity with financial characteristics. That's a fundamental shift in how the market functions, how it's priced, and who the marginal buyer and seller are. In a financially driven market, sentiment, monetary policy, and speculative positioning dominate. In an industrially driven market, actual consumption, inventory levels, and supply chain logistics dominate. The transition from one regime to the other is messy, volatile, and creates opportunities for those who understand the shift. Now, I want to address the bear case, because there's always a bear case. The bear argument goes something like this. Yes, there was a squeeze. Yes, there were temporary shortages. But markets adapt. Higher prices bring out scrap supply. Higher prices incentivize new mining projects. Industrial users find substitutes or improve efficiency. Demand gets rationed. And within a year or two, the market rebalances at a modestly higher price level, not the extreme prices that bulls are projecting. It's a reasonable argument. Markets do adapt. The question is how long adaptation takes and how high prices go in the meantime. Historical precedents suggest that mining supply is highly inelastic in the short to medium term. It takes 5 to 10 years to discover, permit, finance, and develop a new silver mine. Recycling can increase, but silver is often used in such small quantities per product that collection economics are challenging. Substitution is possible in some applications, but not others. So yes, markets adapt. But adaptation might take years, and in the meantime, prices could go significantly higher. There's also a macroeconomic overlay that's important to consider. We're in an environment where central banks have been forced to choose between controlling inflation and supporting financial markets. Interest rates have been volatile. Currency markets have been volatile. Investors are questioning the long-term stability of fiat monetary systems. In that context, precious metals regain their historical role as monetary hedges and stores of value. Silver benefits from both its industrial demand story and its monetary demand story. When both drivers align, the potential move is amplified. When they diverge, the metal faces cross currents. Right now, both drivers are supportive. Industrial demand is strong and growing. Monetary uncertainty is elevated. That's a powerful combination. Let me bring this all together with the key takeaway. The signal that hasn't appeared since the last crisis isn't just volatility. It's the simultaneous appearance of multiple stress indicators, rapid inventory withdrawals, extreme margin hikes, physical paper price divergence, supply restrictions from major exporters, persistent structural deficits. Each indicator alone might be explainable, but when they all appear together, it signals a market approaching a breaking point. And markets at breaking points do one of two things. They break, requiring intervention and restructuring, or they adjust violently to a new equilibrium. Either outcome creates opportunity for those positioned correctly and risk for those caught on the wrong side. If you're just discovering the silver market now, you might feel like you've missed the move. After all, silver was at $30 a year ago and is now at $80 despite the recent correction. But here's the thing about structural bull markets. They don't move in straight lines. They experience violent corrections that shake out weak hands and reset sentiment. Those corrections create entry points for new buyers. The question isn't whether you missed the move. The question is whether the underlying fundamentals remain intact. And by every measure of supply and demand, the fundamentals are stronger now than they were a year ago. The deficit is larger, inventories are tighter, industrial demand is higher, monetary uncertainty is elevated. One final thought. In markets like this, risk management becomes absolutely critical. Volatility cuts both ways. If silver can drop 17% in 30 minutes, it can also rally 17% in 30 minutes. That kind of volatility will destroy leveraged positions, margin accounts, and stop-loss orders. It will create emotional decision-making and panic selling at bottoms. The way to navigate volatility is through position sizing appropriate to your risk tolerance, avoiding leverage, using physical ownership to eliminate counterparty risk, and maintaining a long-term perspective that isn't shaken by short-term swings. The investors who do well in volatile markets aren't the ones who predict every move. They're the ones who position themselves for the big picture and have the discipline to hold through the noise. So here's where we are. Silver just experienced a volatility event that revealed underlying structural fragility in the market. Physical inventories are draining, supplies restricted, demand is growing, paper and physical markets are starting to disconnect. Exchanges are hiking margins to contain risk. Industrial users are scrambling to secure supply, and the mainstream financial media is still treating this as a trading story rather than a supply story. The crisis signal is flashing. History tells us that when similar patterns appeared in the past, they preceded major repricing events. We can't know with certainty that history will repeat, but we can recognize the patterns and position accordingly. Whether you choose to own physical silver, mining equities, or simply monitor the situation, understanding what's actually happening beneath the surface gives you an edge that most market participants don't have. And in volatile markets, that edge is everything. The next few months will tell us whether this was a temporary squeeze or the beginning of a structural repricing that reshapes the silver market for years to come. Either way, it's a story worth following closely, because the signals we're seeing now don't appear very often, and when they do, they tend to matter.